Mortgage rates have stayed higher for longer, and because of that, more and more people are moving away from the standard deduction and starting to itemize on their tax returns. That's because mortgage interest can be deducted when you itemize. Now, paying interest is never better than not paying interest at all. But when rates are high, understanding how deductions work can at least minimize the pain. In this video, I'll break down how mortgage interests affect your taxes and what your effective mortgage rate really looks like after that deduction. In aviation, a waypoint is where you adjust course to stay on track. In financial planning, we call those critical financial events. I created this channel so that no matter what life throws at you, you can maintain the vision to see beyond the waypoint. Let's start by clearing something up. Mortgage interest doesn't reduce your taxes dollar for dollar. It's a deduction, not a credit. Here's the difference. A deduction reduces your taxable income. A credit directly reduces your tax bill. So if you pay $10,000 in mortgage interest and you're in the 22% tax bracket, that might save you about $2,200 in taxes, not $10,000. You're still out of pocket the rest. Now, for some people, that deduction can make a noticeable difference, but only if you're itemizing your taxes. Back in 2017, the Tax Cuts and Jobs Act nearly doubled the standard deduction. Before that, a lot of people itemized because the threshold was much lower. In 2025, the One Big Beautiful Bill Act was passed to make that increase permanent, making the standard deduction for married couples filing jointly $31,500 and increasing each year with inflation. That means if your total itemized deductions don't add up to more than that, you'll likely just take the standard deduction. And if you take the standard deduction, your mortgage interest doesn't give you any additional tax benefit. The same was true for charitable giving, but with the changes made under the One Big Beautiful Bill Act, they'll start allowing an above the line deduction for charitable contributions. There's also now a floor you have to cross before charitable contributions qualify as a deduction. We'll dive deeper into that in a later video. So what all counts when you itemize? The main deductions that usually make up the bulk of itemized calculations are mortgage interest, state and local taxes, also known as SALT, charitable donations, and medical expenses above 7.5% of income. Those are the big ones. When all those add up to more than the standard deduction, that's when itemizing starts to make sense. It is worth noting that mortgage interest is only deductible on loans up to $750,000, whether you are filing joint or single. So let's walk through an example. Say your mortgage is $500,000 at a 7% interest rate. That's close to $35,000 in interest paid in the first year. The standard deduction for 2025 is $31,500. And that's given to everyone, even if you have no mortgage at all. So it's only the amount of the itemized deductions above that number that actually help reduce your taxable income. In this case, you're about $3,500 above the standard deduction. If you're in the 37% tax bracket, that saves you roughly $1,300 in taxes. That means while you paid $35,000 in interest, your effective cost after taxes is about $33,700, which works out to an effective rate of around 6.7% instead of 7%. Now, no one's ever really itemizing with only mortgage interest. If you're itemizing, it's usually because you have a few other deductions add up. And one of the biggest is the SALT deduction, which stands for state and local taxes. That covers things like state income tax and property taxes, but the total deduction is kept at $10,000 for higher income earners. Same mortgage with about $35,000 in interest the first year. Add the $10,000 SALT deduction, and now your total itemized deductions are $45,000. Subtract the $31,500 standard deduction, and you're $13,500 above that line. And that's the portion that actually reduces your taxable income. At a 37% tax rate, that's about $5,000 in tax savings. So instead of paying $35,000 in mortgage interest, you're effectively paying $30,000, which brings your effective mortgage rate to about 6%. Now let's look at the same example, but assume you're in the 24% federal tax bracket. You're now only saving 24 cents for every dollar deducted. But under the One Big Beautiful Bill Act, your SALT deduction cap is $40,000, allowing you to deduct all your state and local income taxes paid. So let's assume you paid enough to have a $20,000 SALT deduction. That brings your total itemized deductions to $55,000 compared to the $45,000 we used earlier. Subtract the $31,500 standard deduction and you're $23,500 above that threshold. At a 24% tax rate, that saves you about $5,600 in taxes. So your effective cost on $35,000 of mortgage interest drops to roughly $29,400, which brings your effective mortgage rate down to about 5.85%. So even in a lower bracket, the higher SALT deduction helps reduce your effective rate, bringing it fairly close to what higher income taxpayers experience after taxes. Here's the bottom line. Paying interest is never better than not paying it. That's just math. But when rates are high, understanding how deductions work can take some of the pain out of it. Your effective rate, which is what you're truly paying after taxes, may be lower than it looks on paper. And if you live in a state with income tax, you'll save at that level too, reducing your effective mortgage rate even more. It doesn't mean you shouldn't refinance when the time comes. It just means that until rates drop, there's a little comfort in knowing you're not paying quite as much as it shows on your mortgage statement. Not all flights will be without turbulence, so it's important to make adjustments when needed. Like and subscribe for more videos on how we support clients in their financial journey, helping them see beyond the waypoint.